Welcome to this explainer. Today, we are diving into one of the most baffling financial anomalies we've seen in recent tech history. We're going to look at how a massive company achieved a seemingly impossible financial milestone, only to watch the market react with absolute outright panic. It is a fascinating story, really. It's got everything from artificial intelligence and fragile global supply chains to the hidden, everyday costs of the tech world's latest obsession. So let's set the stage. In the second quarter of 2026, Samsung reported an operating profit surge of 1,810%. No, you heard that right. That is absolutely not a typo. In just a 3-month period, they raked in an estimated 89.4 trillion South Korean won. To put that into perspective for you, that's roughly $58.4 billion. Basically, Samsung effectively earned more in a single quarter than it did across multiple previous years combined. It's an absolutely historic turnaround, and it was entirely driven by this insatiable global demand for AI infrastructure. But here is where things get weird. Instead of popping champagne and celebrating, the market completely panicked. On the very same day this historic profit was announced, Samsung stock plummeted by nearly 7%, and the sell-off was so severe, it actually dragged the benchmark Kospi index down by 5% and triggered automated trading halts. Think about that for a second. A massive, record-breaking earnings beat resulted in an immediate, cascading sell-off. When you look at the confirmed figures, the sheer scale of this fiscal turnaround is honestly hard to wrap your head around. Consolidated sales more than doubled, and that operating profit literally skyrocketed from 4.68 trillion won to nearly 90 trillion. So we're faced with this massive paradox, right? Why exactly did leveraged institutional investors take one look at these phenomenal numbers and immediately hit the sell button? Well, let's start with Section 1, breaking the memory wall. To unravel this whole paradox, we first have to understand the actual physical technology that's driving this mountain of profit. And it all comes down to advanced AI memory. You see, for decades, the tech industry has battled something called the memory wall. In computer science, this is a systemic bottleneck. While the processing speeds of logic chips have increased exponentially over the years, the speed at which data can be fetched from separate memory modules just hasn't kept up. So in the era of AI, where massive large language models are chewing through petabytes of data, this wall went from being a minor annoyance to a critical system-failing roadblock. Think of it like this. Imagine your ultra-fast logic processor, your GPU, is a hyper-fast master chef, and the memory is the pantry. If that chef has to sprint all the way across the restaurant for every single ingredient, their blazing chopping speed is completely wasted, right? That's exactly what happens when a GPU has to rapidly communicate across a motherboard to retrieve data sets from a distant memory module. The logic chips just sit there, twiddling their thumbs, waiting on the pipeline, rather than actually executing calculations. Enter high bandwidth memory, or HBM for short. HBM solves this memory wall by essentially moving the pantry right next to the cutting board. Instead of placing memory way across the motherboard, HBM utilizes some incredibly advanced packaging to stack multiple memory chips vertically, and then it places that stack on the exact same physical package as the GPU. The data travel distance becomes microscopic. We're talking ultra-low latency and just unrivaled data throughput. It is a phenomenal piece of engineering. Which brings us to Section 2, the AI arms race. Because this highly specialized vertical memory is absolutely critical for training those massive AI models, the manufacturers making it are wielding unprecedented pricing power right now. We are right in the thick of a historic AI arms race, and the global AI memory market is a tightly consolidated oligopoly. Just 3 companies, Samsung, SK Hynix, and Micron, control up to 95% of global DRAM production. If you're a massive cloud provider like Microsoft or Google, and you're building an AI data center, you literally have to go through them. There are almost no other options, which means these 3 companies get to completely dictate the terms of the market. And the whiplash here is just stunning. Just a few years back, in 2022 and 2023, the industry suffered a brutal cyclical crash and a massive supply glut. But then generative AI hit. By 2024, hyperscalers pivoted their infrastructure entirely toward AI, instantly vacuuming up all available high-end memory capacity. Fast forward a bit to May 2026, and Samsung barely averted a historic labor strike that could have crippled this whole global chip bottleneck, eventually agreeing to share 10.5% of its operating profit with chip workers. And then, boom, June 2026, Samsung achieves a massive technological breakthrough, mass production of 6th-generation HBM4 chips, which clock a massive 46% speed leap over previous standards. But get this, Samsung doesn't just want to be the memory guy. They're aiming for the whole shebang. They want to be a total AI solution. Reports are out that they're in preliminary discussions with Anthropic, the makers of the Claude AI model, to actually build custom 2-nanometer logic chips. If this pans out, it means Samsung could help major software labs bypass NVIDIA's crazy expensive hardware entirely, designing and building the logic and the memory all under one roof. That leads us into Section 3, the hidden costs of AI. Now, manufacturing these premium AI chips requires immense resources, and it's creating some really deep socioeconomic friction internally. Thanks to that profit-sharing agreement we just talked about, workers in Samsung's chip division secured these massive, estimated bonuses of up to $416,000. Meanwhile, the workers in the consumer electronics division, the folks making the smartphones and TVs, are slated to receive just $3,900. Why? Because the consumer division's profit margins are completely collapsing, getting squeezed by the exact same memory price hikes that are enriching the chip side of their own company. Talk about an awkward water cooler conversation, right? And externally? Yeah, you and I are paying for this. Producing a single HBM stack consumes 3 times the wafer capacity of standard memory. Because factories are dedicating absolutely everything to these high-margin AI chips, they are actively starving the traditional consumer memory supply. Samsung pushed massive price hikes earlier in the year and is pushing for another 20% hike in Q3 2026. Hardware makers like Apple and Lenovo, they can't just absorb these costs forever. So the end consumer is definitely going to bear this cost through significantly higher retail prices for your next laptop or smartphone. Okay, Section 4, is the bubble bursting? Which brings us right back to our central paradox. If Samsung is securing the technological future, cornering the market, and exacting massive price hikes, why did their stock crash? Well, the answer lies in how markets look at the future. Institutional investors realized pretty quickly that Samsung's massive 19-fold profit surge is almost entirely a pricing story. It's being driven by macroeconomic supply constraints across the whole industry, not just some exclusive competitive victory for Samsung alone. Investors are terrified because if this profit relies entirely on industry-wide pricing inflation, the moment that pricing leverage breaks or the second supply catches up, those massive profits could evaporate just as rapidly as they appeared. This skepticism was actually formalized in July 2026 by Morgan Stanley, who warned that the market was hitting a peak rate of change. Now, this doesn't mean prices are crashing just yet, but the acceleration of growth is maxing out. Their thesis is pretty straightforward. Number 1, pricing momentum is cooling. Basically, sequential percentage gains are shrinking. Number 2, inventory is stabilizing as the supply chain finally absorbs that initial AI shock. And number 3, revision breath exhaustion. That's a fancy way of saying almost every analyst has already upgraded their forecast to the absolute maximum. When perfection is already priced in, there is literally nowhere for the stock to go but down on any hint of macro anxiety. And that anxiety is severely compounded by the spending habits of the tech giants. Hyperscalers like Microsoft, Meta, Google, and Amazon are projected to spend a combined $725 billion on capital expenditures in 2026 alone. $725 billion? That is a staggering sum of money pouring directly into hardware infrastructure. But here is where the math gets downright scary. According to Epoch AI, by the third quarter of 2026, these companies' infrastructure spending might actually exceed their operating cash flows. They are spending so much on AI data centers that they may be pushed toward debt financing just to keep the lights on. Analysts are terrified that these tech giants have defensively overprocured hardware, and if the software doesn't start paying the bills soon, they're going to be forced to drastically slash their budgets. And we are already seeing some real cracks form in the consensus. Meta is reportedly exploring the creation of a cloud business specifically to sell off their excess bare metal AI computing capacity to external customers. Think about what that actually means. It signals that hyperscalers might have built way more infrastructure than they actually need to use internally, and now they are desperate to monetize that idle capacity. If they stop buying chips, Samsung's pricing power vanishes overnight. So this leaves us with the ultimate question. As the immense costs of the AI revolution get passed down to everyday consumers like us, and tech giants continue to burn through hundreds of billions of dollars in cash, will AI software applications ever generate enough actual revenue to justify this nearly $1 trillion hardware sprint? Or is the peak of the supercycle already behind us? Let me know what you think, and thanks for joining me on this explainer.